all right, I've seen enough of them. I've went on TikTok enough and YouTube Shorts enough and all of the other places to see enough cringeworthy, bad advice insurance TikToks. And I'm here to react to all of them and give my opinion and my 2 cents on what I think about them. What is up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped hundreds of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. If that sounds interesting, I'll put the link in the description below. But without further ado, let's get right into this video. Okay, before I get into this video, I just want to maybe give you guys a little bit of my history and my background in the insurance industry, just so you know I'm not like some, out of the MLM 1 year in the industry, let me react to these TikToks. No, I've been in the industry for almost 10 years now. I've done a lot of things in this industry. I've worked quite a bit with families, doing a lot of just term life insurance, things like that, and critical illness and disability. But most of my work has been done more on the advanced side of insurance. So working with wealthy business owners, doing kind of high net worth estate planning, passing down $1 million corporations to the next generation or selling them, setting up holding companies, setting up family trusts and other complicated estate planning mechanisms, working with teams of lawyers, working with accountants, going across Canada and doing seminars for hundreds of different accountants. I also have an accredited curriculum here in Canada that I built for other advisors to teach them about the complexities of life insurance, as well as the complexities of leverage strategies, which is what you hear most often on TikTok, which is, invest in life insurance, quote unquote. You can leverage it. You can use the life insurance and you can use it as a quote unquote wealth building mechanism. I've also written white papers specifically on those wealth building strategies, which have been peer reviewed by lawyers and other financial professionals. So here's the thing. What am I trying to say? I'm not trying to brag, but I am trying to give you a little bit of context, because that's important. Because when you watch these videos of people, A, people doing the TikToks, or B, people reacting to them, you should know where you're getting this information from. Has this guy been in the industry for a year, or does he have 10 years in this industry and he has a little bit of background dealing with these complex strategies? So just know that I know a little bit about what I'm talking about, and I'm not trying to brag, but I am trying to say you should look at the context of who is speaking. And if the guy looks like he's been in the industry for a year, maybe don't take advice from that person. Maybe look for more of a seasoned professional in the insurance industry. But let's just start getting into some of these videos.
Here's one of the smartest investments that no one's talking about: life insurance.
Okay.
They have what's called dividends. As you put money into it, it grows over time. It also has what's called a cash value. You could actually take the cash value out of it and then use that money to go invest in things. You could borrow against that cash value. You're paying an interest rate on it, but you're paying yourself the interest rate on it. You can use that money.
You're not paying yourself that interest rate. You are paying the insurance company that interest rate. And yes, as a participating policyholder, you do receive dividends on the performance of the insurance company. So quote unquote, you're paying yourself? No, you're paying it to the company that you receive a small portion of their profits back to your own policy. You're not paying yourself. It's just a little twist of words there, but let's keep going.
Money to go invest in something that's going to produce 10% returns. You could go invest in real estate, go invest in the market, whatever you want to do. You become your own bank. That produces a revenue stream for you. At the same time, the life insurance policy does not reset and it keeps growing. One of the smartest ways to invest in things, to not be dependent on banks, and become your own banker and build it.
You're still dependent on banks.
Here's one of the smartest investments.
Okay. Yeah. Okay. So this guy's basically just talking about infinite banking. By the way, so infinite banking, and I'm making a video on this, infinite banking is just a marketing strategy built upon life insurance, specifically whole life insurance. So we've had whole life insurance for hundreds of years, okay? And we've had the mechanism of borrowing against your whole life insurance for hundreds of years as well, a very long time. All infinite banking is a bunch of guys got together. One guy specifically, his name's Nelson Nash, and he's like, hey, what if we just use it this one specific way, leveraging against life insurance policy and quote unquote being your own bank? And then he started the concept of infinite banking. But at the end of the day, infinite banking is just a genre per se of leverage strategies. And all leverage strategy is using permanent life insurance to grow the cash surrender value of it, and leverage meaning a borrow against it. And you can do this front end leverage or back end leverage, or, in the middle, I guess, as well. But it's just another strategy. There's nothing secret about infinite banking. Like, they act like they have like this secret formula and it's like this magical thing. It's not this magical thing. So listen, I made tons of videos on this, and you'll know if you follow my channel for any amount of time that I'm pretty opposed to this type of strategy. Let me break into it a little bit more. I don't think that investing in life insurance, quote unquote, and using it as your own bank, quote unquote, kind of the secrets of the wealthy, I don't think it's necessarily a bad idea. I have a lot of clients that are doing this. I have a lot of high net worth clients and business owners that are buying permanent life insurance and leveraging against it and using it exactly what this guy said in real estate, buying investments. You can write off the interest as well if it's used for the purposes of business or the purposes of an investment. And if you're wondering what the section of the Income Tax Act, that's Income Section 20 Bracket 1 that talks about the deduction of interest and when that's applicable. So listen, I mean, he's not wrong, but what kind of he's failing to say is that like it works a lot better for individuals that are already high income earners and that have already taken advantage of other wealth building opportunities and that have excess capital, like large excess capital that they want to put into this policy. And they're okay letting it grow for 3, 5, 7 years, build up the cash value in it and then leverage against it and start putting it towards some type of investment. I know the financial advisors that'll be on this channel, they'll be like, but you can do it in the first or second year. Yeah, you can, but it works way better if you wait and let it grow for a while. Like I have a client right now that I'm working with that's going to be doing $100,000 a year in premium, and they're going to be doing that for 20 years. It's $2 million they're going to put in this policy. So I'm not against this type of strategy. However, the problem that I have with this is he's talking like this is the secrets that the wealthy do. No, this is just something that the wealthy do, but that didn't make them wealthy. They got wealthy from being a high income earner, from starting a business, making a lot of income, and they've probably taken advantage of already other things like your TFSA or your RSP, and they don't have any high interest credit card debt. So for the vast majority of people who like 70% of Canadians make less than $80,000 a year. So like when you think about those kind of numbers and you start to think about like where this strategy is really applicable in that like 20 to 30% of Canadians, but the way that he makes it sound is like it's for everyone. No, it's not for everyone. There's so many things that can go wrong. Like you can lose your policy if you can't pay it for some reason. You can lose your policy. You can lose all your money that you put into it, especially in the early years. In the later years, maybe it's not as bad, but you'll lose a lot of the growth. And there's just like added complexities. You need to pay the interest costs. And yes, you can capitalize it, but then you lose out on the death benefit. So like if you're of the vast majority of the population, I would say this is not a good idea. Focus on other strategies first, like an RSP, a TFSA. Here's the thing. You can put money into your TFSA. It can all grow tax-free. But then the next year, if you don't have the money, it doesn't blow up. Like, you know what I mean? Like you don't lose that money. Like it's still growing. It's still all tax-free. And then next year you can put it in again. So it's just like, it's a little bit disingenuous. It's a good strategy, but it's not for everyone.
Insurance secrets only the rich know. Rich people don't.
Okay, see what I like right as soon as we start this video, it's like insurance secrets only the rich know. It's like, no, insurance secrets that rich people use because they have extra money. It's not something that's like a secret. Like, I mean, it's everywhere on TikTok, so it's not that much of a secret. Okay, let's keep going.
Use life insurance to protect their family in case of their death.
Yeah,
they're already rich. They don't need a policy.
Yeah, I mean, at the same time, if they're like young, 30, 40, 50, they can just get a term life insurance product for virtually nothing to protect their family. Would they want to use $5 million of their own cash or $5 million of cash that costs them like pennies on the dollar for a cheap term insurance product? So no, rich people still buy term life insurance. Don't let him fool you.
Policy to protect their family. They could just leave them their wealth. It's kind of a no-brainer. Rich people actually use life insurance policies to build more wealth.
That's true. That's 100%. Rich people do use life insurance policies to build more wealth. That is true.
There are many types of life insurance policies, but generally speaking, a permanent policy allows you to grow your cash value by around 5% or more tax-free annually. And that's just the beginning of what it can do. But it will also continue increasing the actual death benefit of the policy.
Yep. So he's totally true here. So he's talking about paid up addition. So he's probably talking about like a whole life insurance policy with paid up addition. So basically a portion of that is going to the insurance company as like an extra fund, quote unquote. And they're using that for a multitude of different investments that, you know, they have control over the insurance company specifically. So they're investing in, you know, real estate, alternative investments, et cetera, et cetera. And they're getting like pretty good returns anywhere from the 5 to 10% range. However, what they'll do is they'll blend this return for you. So you're typically going to get a 5 to 6% dividend return. And that's usually every year. So it is a relatively safe place to store your wealth. So if they make 10% in any given year, they're not going to pay you at 10%. They're going to pay you at that 5 to 6%. So when they have, you know, rainy years and they only make like 3% or 2%, they can top that up with what they've made in previous years. So, and that grows not only cash surrender value, but it also grows your death benefit as well. So yeah, this guy's on the right track.
The death benefit is what most people think of when they hear the life insurance to begin with. The death benefit is the amount paid to the beneficiary in case of, death. The most important feature of these policies, though, is the ability to borrow against them. It's your money and you can take out a loan against it tax-free.
Okay, let me touch on this. So there's a couple different ways you can access the cash surrender value within a permanent life insurance policy. There's different types. I mean, there's whole life insurance and there's universal life insurance. I'm just going to talk about whole life just to make matters easy. So the couple of different ways you can do it. One is a policy loan, and that's where you're actually getting a loan directly from the insurance company that issued you the insurance. In the States, they have different tax legislation than here where I am in Canada. In the States, policy loans are not taxable at all. However, in Canada, they are considered what's known as a disposition of your policy. And so anything in excess of the adjusted cost basis of your policy will become taxable. And you're probably like, what the hell is ACB? Here's the thing. In the early years of your policy, you're going to have a very high adjusted cost basis. And so if you took a policy loan in the early years, it's not going to be taxable. However, in the later years, when, you would want to get a policy loan per, retirement or something like that, take it out, how these guys pitch it on TikTok, your ACB at that point is probably going to be way closer to zero. And your policy loan will probably be taxable and it'll be added as taxable income, to your income return for that year. So that's a policy loan. The other way is a collateral loan. A collateral loan is something that you secure by pledging this as an asset to a third-party institution like a bank, and you get a loan on that essentially, and they're on assignment. So if you were passed away, it would wipe out the loan. And now this is not taxable at all. However, there's a lot of complexities to secure this type of loan. It's not as easy to just go out and get a policy loan anyone can have with their policy. Doesn't matter about your credit and doesn't matter the amount that you're taking. However, with a collateral loan, your credit worthiness does incredibly matter. You need to have good credit and your DSR needs to be in check, which is debt service ratio, pardon me. And also the amount that you're going to be getting as well needs to be considered. So collateral loans typically aren't issued for like a couple $1,000, right? They want to see like some, 50,000, 100,000, 200,000, 250 or more. Typically, most lenders want to see more than $500,000 before they lend on this. If you want to get preferential rates and if you want to lend up to the maximum of 90% of your cash value. So it's not something like, hey, can I take a couple $100 out of my policy with a collateral loan? Probably not.
You're taking out a loan against the cash value that's not considered income, and therefore it is not taxed as income.
Unless everything that I just said.
So you could use the loan to buy an asset like real estate, which will create enough passive income to repay the loan and create you additional cash flow on top of just paying back the loan that you loaned yourself tax-free to protect your family. Listen, I know it's a lot of work to learn everything that they should have taught us in school, but it's pretty easy.
I don't know if they should have taught this in school, but okay.
To follow a channel full of short educational life hacks.
That's true. Yeah. So again, totally. He's not wrong. I feel like I'm just beating a dead rabbit or something like that. He's not wrong. It can be a good strategy. However, at the end of the day, listen, for a lot of people, this is not the best strategy. There's a lot of complexities that can arise from it. There's a lot of things that can go wrong. Most of the time, it's just better to get a term life insurance product and focus on like simple, easy things, RRSP, TFSA, paying off your high interest credit card debt and building your wealth up and then potentially looking at it in the future. So this isn't like a secret of the rich that only the rich know. And it's like, if you do it, you're going to get rich. No one's ever gotten rich by buying life insurance. If you could get rich by buying life insurance, everyone would be buying life insurance. Like, think about that. It's kind of like when you think about those ads you see, if you see an ad like, click here, you won't believe I made $1 million and I'll teach you how to do it. Like, think about it rationally. If you had a secret formula to earn $1 million, why would you teach it to anybody? You would just continue to make millions and millions, millions, and millions of dollars. Okay. Nobody gets rich by buying life insurance. Rich people store their wealth in life insurance once they've made it. It's very similar to real estate. Real estate's not a great place to get rich, okay? You have to have a lot of assets. There's a lot of things that can go wrong. There's a lot of cash that you need to raise. I know people who try to get rich buying real estate, and it's not a great way to do it, but it is a great way to store your wealth. It's a very relatively safe way to store your wealth if you already have it. Life insurance is the same way. So if you're rich and you're looking for another place to store your wealth, yes, life insurance can be a good option. If you're not rich, it's not the way to get rich.
It's whole life insurance. And this is probably the most underrated, undervalued investment of all time. And I believe in all my heart it's kept this way because they don't want it to become some public thing.
Who doesn't want it to become some public thing? Who's like keeping the secret of like hacks that life insurance companies don't want you to know? Why would a life insurance company not want you to buy life insurance? Like just think about that rationally. Why? Like look whatever city you're in, look downtown and look at the biggest buildings downtown. Who are they? They're financial institutions and insurance companies. So do you really think that the largest companies that are trying to make the most money in the world have this secret that they don't want you to know? No, they want to sell as much as possible. Like
Chase Bank owns the most whole life insurance of any bank, $500 billion or something like that, right? And all these millionaires and billionaires and private equity funds, all they're doing is taking this money that they're making from their businesses when they,
millionaires and billionaires are using this. Yes, I absolutely agree with you. Millionaires and billionaires are using this because it is a good strategy for wealthy individuals.
Go and buy a business small and build it up and sell it. They take that money and stick it in your real estate and then, stick it in whole life insurance.
Yep. Or both.
Then when it's in whole life insurance,
you can leverage it
again.
I nailed it, baby. I don't know. What do I want to say in this? For sure. Wealthy people are using this. They are leveraging it. It is a good strategy for some wealthy people that are comfortable with leverage and taking on debt essentially until they die, which is a scary proposition. There's a lot of wealthy people that are very adverse to leverage. Like they don't want to see outstanding loans, and it's just their psychology and their heuristics when it comes to money. And that's not a bad thing. Like, listen, at the end of the day, here's the thing. We're not robots, right? Like just because something mathematically makes sense, and it's like, if you do exactly this dollar for dollar, you're going to be, X amount percentage ahead when you die. You're going to have 13.75% more, whatever it is, right? However, that means you need to rigidly stick to this schedule no matter what, pay this exact amount, put this in this exact bank account, pay this, no pizza nights, like da-da-da-da-da. That's not how we live as human beings, though. Like things happen, life changes, we change jobs, we change businesses, COVID happens, everything's get thrown up into the mix, like problems happen throughout our life. We want to spend our money. We want to maybe move to a different country, want to go all over the place. So like, we're not robots that are like consumed by this financial desire to have the biggest bank account at the end when we die. We also just want to live life and enjoy life and like do things. And I'm not saying you can't do that if you buy a whole life insurance policy, but I'm saying like, we're not robots. Things happen. Some people don't like having millions of dollars of debt hanging over them, even if mathematically it's better to have that debt because in the end I'll have more money. Some people are just like, I know that my mortgage is only 4%. And if I didn't pay off my mortgage, I could invest that and make an average of 6 to 7% or whatever it is. And that 3% difference is better for me. However, I don't care. I just want to have the security knowing that my house is paid off and I'm good now. I'm good. I don't have to do anything. I'm not stressed. Like that's something that these guys don't ever take into consideration is like the psychological stress of having to pay big loans, the interest on big loans and continue to pay them or capitalize them and hope that your dividend rate is going to be higher than your interest rate on that and it doesn't collapse the policy and you don't have to put up additional collateral. Nobody's talking about that. So yeah, it can be good, but we're not freaking robots. Like we have feelings, we have emotions, more things. If there's more to life than just numbers in your bank account.
I'm a licensed agent and I got a life insurance policy on my daughter when she was 14 days old.
I watched a video of this guy before and I agreed 100% with what he said. I gave him a 10 out of 10, but I have a feeling that I'm going to give this a 0 out of 10. I'm sorry. What's his name? Prince? I'm sorry, Prince. You have some good videos, but I think this one's going to be a 0 out of 10. Let's go.
It's called Children's Whole Life. Now,
Children's Whole Life. Okay, let's just watch it. Let's just watch it, Philip.
Think of life insurance and say, well, if I pass away, the death benefit goes to my family. When we're talking about Children's Whole Life, this is about teaching your children the importance of creating generational wealth. I got her a $50,000 policy.
I love how I hope that's his daughter. I think that is his daughter. If it was like somebody else's, can you imagine there was like rent a baby? Like, hey, I'm making an insurance commercial. Can I rent a baby for a day?
And it was only $9 per month.
Her parents are like right there, like, honey, she's crying. Shut up. It's $100 an hour. Just give her the baby.
But the part that was most important, the part that was most
Kisses were extra.
was that she gets to keep this $9 price point for the rest of her life. It's locked in. So now, when she lives a long life, when she passes away, my grandchildren are also going to get a tax-free life insurance check because I did this for her early, and I'm teaching her the importance of life insurance while she is young. So I encourage everybody, have a children's whole life insurance policy for your children if they're under the age of 18 years old. Only takes 15 minutes.
Hang on, is that the end of it?
Licensed.
Yeah, okay. All right, let's talk about children's life insurance because I get this question quite a bit. There's a video on the channel somewhere where I talk about life insurance for a child. Here's the thing, okay? First of all, let's look at life insurance from a dependent point of view. So most of the people that buy life insurance buy it because they have dependents in their life, such as children or a partner or a spouse or aging parents, where they would be financially impacted if they were to pass away. So you get term life insurance to cover that off or whatever, permanent, whatever option, okay? But I mean, that's the purpose. It's like if I die, people are financially impacted because they're relying on my income. Let's look at a child. What income are we trying to replace with a child? None. There's no financial impact. Yeah, you might take, a few months off work and, maybe you should focus on your emergency fund within your own financial situation first. I get that. Okay. So the pitch for getting whole life insurance on your child is like the same pitch that they use for getting whole life insurance on anybody for that matter. It's this quote unquote wealth building opportunity. And just like I have the same opinion for buying whole life for, again, the middle income class, the low to middle income class, I have the same for your child. So, they say like, oh, you could use it for education or you could use it to buy their first home or to buy their first property. Da, 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 da. Here's the thing. We already have a lot of really great programs. I know there's a lot down in the States. We have some in Canada, the RESP, Registered Education Savings Plan, where the government will like match and bring up and put grants into that. And it's all tax deferred and they can use it for their education. So I would say just like an individual, I would say the same thing with this strategy. It could be a good strategy. However, there's so many other mechanisms that you should get in place and you should look at all of your own personal financial matters first. Get your own life insurance, your own RSP, your own TFSA, probably your own, at that point, if you're that high of a high income earner, your own whole life insurance policy that you're funding with, real estate that you're purchasing, yada, 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 and then get, life insurance for your partner. And then also get an RESP set up for your child. If all of those things are then done, then sure, if you're looking to build this wealth building, you get this wealth building strategy for your child that they can leverage later on in life to, whatever, buy a car or buy their house. Sure, it's not the worst thing in the world, okay? However, there's so many other things that you need to get before this is ever considered an option. There's like da. So, and this guy didn't put any of them in there. He's just like, boom, buy this on your child, like 15 minutes, da. Like just the way this is designed, it's like advertised towards those lower to middle income families that don't have a lot of expendable cash. I do not think this is a great idea for the vast majority of people. However, just what I consider for other people, just what I say for other people looking at permanent life insurance, it can be a good option, but it's probably not the highest on your priority list.
Here's why you need life insurance right now. So you died at 36 years old. I know you don't want to believe it, but it happens. Now, you have a job making $50K a year. Your husband, John, has a job making $50K a year. You got two kids, Jay and Jasper. Now, your income moves to zero because the job ain't going to pay you no more. You're dead. So now John's $50K income has to cover a house, which is $1,500 a month, a car, which is $400 a month, daycare, which is $2,500 a month, and living expense, which is $2K a month. Now, while your husband, John, is mourning your death, the funeral director is smiling right now because he's about to receive a check for $10,000 to
pessimistic.
bury him. But it gets worse. Now that your spouse can't afford
this is the same guy, Prince Donald. Yeah, the same guy
knocking on the door. And guess what? Since John can't afford this salary of $50K to cover all these costs, now the house is getting foreclosed upon and the car. It sucks. Now your kids are crying because they have to move and they don't even know why. But it gets worse than that.
How many views does this guy have?
Now your family is feuding over figuring out how to pay for this, slurring all types of FU words back and forth. They're feuding. Now you got to go to GoFundMe to be able to raise money to bury you, which that's embarrassing. Now,
yeah, okay, so hang on. So far, I actually agree with everything this guy's saying. I'm just reading one of the comments. So he says, like, LP Advisor says, yes, this is true, but the scared tactic is kind of harsh. For sure. Like, I mean, I agree with everything this guy's saying so far. I imagine he's talking about just getting like some term life insurance product. I mean, this is the main reason why you get life insurance, is just to protect your loved ones within your life, like your wife, your husband, your kids, to help pay the bills, help pay the mortgage. But I mean, this is pretty pessimistic of a view. This is kind of like a scare tactic point of view. Like, here's what's going to happen if you don't buy life insurance from me today. It's just, anyways, let's keep going.
All you have to do was contact a Jack Life Insurance agent. Your spouse and kids would have been happy because you have a $300,000 policy for $30 a month.
Yeah, sweet term life insurance.
Click learn more.
I like this guy. Yeah, I mean, so for sure, I'll give this a 10 out of 10, maybe a 9 out of 10, just because, he's being a little bit harsh, but, that's okay. That's the nature of what it is. But one of the things that he did mention, which I want to touch on, he mentioned GoFundMes, and like that's actually legit. So one of the things that I do personally as a hobby is I do a ton of ice climbing, rock climbing, backcountry skiing, mountaineering, climbing mountains, basically. And I've done this for years, and it's a passion of my life, and it's really important to me. However, unfortunately, I mean, the harsh reality of it is that a lot of people do die doing what I love to do. And it's constantly shown on the Facebook groups and shown all over the place. And it's like every 2 weeks or every month, I will see another GoFundMe come up asking for money because, this individual didn't have life insurance or didn't have some type of accident insurance or some other type of policy, and they have outstanding medical bills, or their family is left with nothing and they're trying to pick up the pieces. And so it is super sad. So when he talks about the GoFundMe, I think that it is kind of like, he is a little scare tactics, but at the same time, I mean, he's not wrong. Like that, the basically our competition for life insurance is the status quo. Like, it's not like we're trying to like compete, like, oh, you have life insurance, we have better life insurance, right? Like that's not really necessarily our main competition. Our main competition is you don't have life insurance, and our competition is status quo. What happens if you do nothing? And the do nothing, unfortunately, is a GoFundMe. And like typically these things get funded like 30 grand or 50 grand or something like that, which is like nice. It helps for the funeral and like maybe like a month or 2 or 3 months of funding. But after that, it's gone. And now it's like the harsh reality of like, okay, what do I do now? How do I take care of the kids? How do I take care of this house? How am I going to move forward? How am I going to like go back to my job that now that I'm like dealing with this like tragedy that I just went through? So yeah, I mean, for sure, this guy's a little bit harsh on it, but the reality is absolutely, if you have a family, like get a cheap term life insurance product, 100%. All right, I think that's all the videos that I'm going to react to today. If you guys enjoyed today's episode, I will make more of them. And if you guys have any questions, just drop them in the comments below. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.